everyone, this is a little example I thought of I typically do in my in-person classes on the first day. This is aimed for someone who might be brand new to accounting and know nothing at all about what accounting even is. So basically in accounting, we're showing the records and the story of our company, what's really happening behind the scenes. So in this example, we're going to use this kid scale to represent our company. And we're going to say that this equation, which represents our accounting equation, has to be here in the middle and balanced at all points in time. Okay? Our accounting equation, if you remember, is our assets are equal to our liabilities plus our equity. So let's talk about what that means for the purpose of our accounting equation scale here. So on the left side, this represents our assets. These are the resources of our company. These are things like cash, things like inventory we might sell for our company, land. And then the example today, we're looking at a photography business. So for a photographer, our assets will be a camera and a computer. Okay, so again, on the left-hand side over here, these are our assets of our company. These are the resources we're going to use to generate income and revenues for our business. On the other side of our equation, over on this side, we're going to represent our liabilities first. So our liabilities are things that we owe. We are legally obligated to pay these. Things like a loan. We can't get out of it. We're legally obligated to pay it. So that's going to be our first bucket right here. On the other side of this bucket is our equity section. And our equity section is basically the residuals. We often call this the leftovers. This is basically what our owner has in the company. It's going to go up when our owner puts money in the company. It's going to go down when our owners take away money or withdraw money, which is often called a dividend. It's also going to go up when we generate revenue for our primary business, and then it will go down for the cost of doing our business, what we call expenses. So those are the primary things that are going to impact our accounting equation. Example, we're going to be using these little bitty bears right here. You might have come across these maybe in elementary school. So we're going to put these in to represent transactions in our business. And after each transaction, we want to make sure that our accounting equation here is still balanced. Okay. In this example, we're a photography business, as I mentioned earlier. So our first transaction is we're going to contribute $800 in cash to start our photography business. So I'm going to put 8 of these little bears representing my cash on the asset side of my equation because I now have cash for my business. On the other side of my equation, you can see it's not balanced. In the equity section over here, I'm putting in that I now have common stock. It's proving that I own a piece of a company. And so we're going to put 8 on the other side in the equity section. Okay, and after each transaction, I double check to make sure my equation still balances. All right, our next transaction is we're taking out a loan, a small business loan, and we're receiving cash. Because I'm getting cash from my loan, I receive cash. I have even more cash for my business now. Okay, so I've got a lot of assets and resources for my growing business. But on the other side, you can see it's not balanced. I have a loan. And a loan is a type of a liability. So I'm going to put them right here, showing these are other people's claims on my business. So I'm going to put them here on the other side. All right, and now my equation should be balanced again. Okay, so you can see now I've got quite a lot of resources, cash for my business. I've got a liability, a loan that I owe to someone else. And I have ownership over here. Okay, so again, on the one side, I've got my resources, and then the claims on my resources for my company. All right, my third transaction in this example is we're going to be purchasing equipment for our business. So we're going to be buying a camera, a lens, and a computer for our business, and we're using cash to do that. So in this transaction, I'm going to start taking money out of my business, and I'm going to be spending a total of $900. So I'm going to pull out 9 of these. And then I'm going to be buying again a camera, a lens, and a computer. So I'm actually going to be putting them right back in as new assets in my company. So I've got my camera going in, a big fancy lens, and then finally my computer. Okay. So again, at the end of each transaction, my equation is still balanced, even though everything this time only impacted the asset side of my equation. And you can see after every transaction, we always have our accounting equation staying balanced. Our assets are always equal to our liabilities and our equity. Okay, in addition, we also always touched at least 2 different accounts as part of every transaction. All right, so now my business for the month might be complete, and I would make my company's financial statement.